All right, with George Ogilvy, CEO of Arizona Sonoran Copper, ASCU on the TSX. Good morning, George. How are you?
Hey, I'm well, thank you, Robert.
Before we get into Arizona Sonoran and the Cactus Mine, I want to also pick your brain on copper mining in the U.S. I don't really know much about your background. So how did you get into the mining industry, George?
Well, all of my forefathers, believe it or not, way back in Scotland, were coal miners. And my father was the first Ogilvy that actually went and did a diploma in metallurgy. So I'd always been interested in sort of the engineering side of the business. And then with having all my forefathers, grandfathers being, in the Scottish coal mines, I think that's sort of what got me interested in mining. And then, of course, in 1980, when I was at school doing a mining degree, Margaret Thatcher was in power and she was closing down a lot of the coal mines and breaking up the unions. So there wasn't really much opportunity for me to get a job in my field. And I had to look a little bit further afield and was very fortunate to get an offer from Anglo American to go and join their gold division in South Africa way back in 1989. So I spent 8 years down there working in, probably some of the toughest and most challenging mines in the world, not just physically, but based on, the size and obviously the dynamics of what was going on within the country at the time.
Ah, that's a good history. So you're Scottish. I kind of picked up on that, although sometimes, us Americans can think, oh, it's Australian or it's British. But yeah, I kind of picked up that you're Scottish. Not a lot of Scots in the mining sector, at least not a lot that I know of.
Not today. I mean, when I did the mining degree at Strathclyde University, I was in the penultimate year. And the year after I graduated in 1989, the program was closed and actually moved, I think, then to Leeds University. So there's only, I think, 1 or 2 mining schools remaining in the UK that actually teach, some form of mine engineering. Subsequently, there's not a lot of students that go into that discipline or that career over the last 2 to 3 decades.
Yeah. And that's something that we face in the U.S. as well.
I
think we only had 270 college graduates in some sort of mining focus in the last year. So in a country of 340 million, to have 270 graduates. So we have a dearth of talent. Maybe that's something we'll talk about a bit later. Okay, so you got into the mining industry in the 80s. You worked in South Africa at some of those deep underground mines, I'm guessing.
Yeah.
And then eventually made your way over to Canada and now the US. So you live in the States now?
Yeah, I live in Toronto, Canada.
Okay.
So in 1997, when I'd met my wife, we wanted to settle down, start a family. Didn't think South Africa was a good, place at that time to start a family, and was very fortunate to get a transfer to Anglo Base Metals. And back in 1997, they actually owned Hudson Bay Mining and Smelting up in northern Manitoba. So in March of 1997, I came across with my Greek South African wife, and we ended up in northern Manitoba and have settled in Canada ever since.
That's the cool thing about mining. So you started in Scotland, you went to South Africa, you went to Manitoba, you still live in Canada, but you work, on a project in Arizona. You're all over the world. It's very interesting.
Well, when I started out, I had to learn my, profession. So I spent the first 20 years of my career really at the mines and operations. So, when you're in operations, you have to go to where the mines are, and the mines aren't generally located in the big cities. They're usually out in the middle of nowhere. So I had 7 years up in northern Manitoba in the Flin Flon camp with Hudbay. I then spent 3 years with Dynatech and FNX in the Sudbury nickel camp, bringing some of the old Inco mines back into production. I then went into an executive position with Rambler Metals and Mining on the Baie Verte Peninsula, where we started up the Ming mine, which now rests with Firefly. Had 7 years there, then went into Kirkland Lake Gold in Northern Ontario as the CEO, based out of Toronto at that time, and got that one turned around and put back on the rails. Then from there went into an infamous story known as Rubicon Minerals, that had built a mine in the Red Lake, Northern Ontario gold mining camp on the back of a PEA that was going through a CCAA restructuring. So we got that restructured, and then 4 years later, the company was sold to Evolution Mining, the Australian gold mining company, for an all-cash offer of, I think, 47% premium. So it was the highest share price that the shareholders in the company had seen since the 4 years from the restructuring. And then quite literally the day after we closed that deal in May of 2021, I was contacted by a headhunter who was looking for a CEO for this company. And back then we were known as Elam Mining, given we were private. So after conducting a couple of months of due diligence, I ultimately signed on the dotted line in July of 2021 and have been with the company ever since.
Great background, yeah. The Rubicon story, I do remember that, and it's also some lessons there. Building a mine on the back of a PEA may not be the most prudent move. So you're a mine builder, you're a restructuring guy. It seems like you're the guy they bring in to put the project to the finish line, or to fix what may have not been working previously. That's a pretty valuable set of skills that you have. So now you're at the Cactus Mine in the Arizona Copper Belt. This is not, I don't think this is really a fix, although it was a formerly operating
restart. A restart of a brownfield operation. Was very much like what I inherited when I went into Rambler Metals and Mining with the Ming mine on the Baie Verte Peninsula. That was an old Irving mine that was mined in the 1960s, and it ultimately closed in the early 1980s. So when I went in there in 2007, the mine had been closed for approximately 25 years. It was completely flooded. There was no 43101. At that time, we were listed on the AIM market in London, but not in Canada. And, we had very little money, and we were only 4 employees on the payroll. And over the course of 3 to 4 years, we did all the technical studies, developed a resource, raised the finances, dewatered the mine, ultimately put the mine into production and grew the entire company labor force to about 160 people at the time. We listed on the Toronto Venture Exchange, so we were dual listed. And actually we caught, a couple of decades ago, your listeners may remember that there was a brief period of time there where copper went over $4 a pound of copper. And we actually caught that cycle. And for the first 2 years of commercial production, the mine was actually profitable and generating free cash flow. So definitely got a track record as well of, putting old former producing mines that are now brownfield sites into production as well.
Very good. Yeah. So Cactus was an operational mine called the Sacaton Mine in the 70s and early 80s. And then I don't know the whole history between then and when it was put in your hands in 2021, but I assume it was on care and maintenance for most of that time, just kind of sat dormant during some challenging copper markets and maybe some unfavorable permitting environments in the US. But we'll get into that in a second. I want to talk about Arizona more broadly. So the state of Arizona is a copper mining state. Obviously, it's the most important copper mining state in the US. It's one of the most important places in the world for copper mining. And what's interesting is the state has so much more potential. Yeah, there's a number of operating mines. Some of the biggest copper mines in the world are in operation in Arizona.
Yep.
But it has a lot of potential for more copper mines to go into
Oh,
operation.
absolutely.
What's the mood like in Arizona right now, George? I mean, as a CEO of a copper mining company focused in Arizona, what's the mood like here with some of the things we're seeing in the media?
Well, I think, specifically for the copper industry, I think the mood is very upbeat. I think most people within the state, and certainly, people that I've spoken to, recognize that the demand for copper, as we move forward with the green energy transition, is only going to increase. And I think they recognize that, around the world, there's going to be further constraints when it comes to actual supply. So I think with respect to, the copper industry itself and being able to grow that within Arizona, I think a lot of people are very, very upbeat about that. Of course, there are people who are a little bit nervous as to, what are ultimately going to be the impacts of the tariffs. I think ultimately they will surface with respect to inflationary pressures, which are going to have to be passed on to the public. And we will see, businesses, suffer inflation from the tariffs that ultimately are in place currently, and maybe future tariffs that come into play. So that could put a little bit of a squeeze on, profits and margins. But one would have to think as well that we're going to see a rising copper price here, just based on the supply and demand fundamentals. And that would be my take on it, that ultimately the copper businesses within Arizona do extremely well. Where there's going to be challenges, however, is that, there is a portion of copper that's produced within the state that is actually in a concentrate form. And right now there are only 2 operating smelters in the US. And there's a third one, the Hayden smelter in Arizona, which is currently idled. And there's been some talk recently about that, coming back on. But, if the copper is produced in concentrate form, it doesn't make sense if it has to go offshore for further smelting and refining. And typically that ends up going into Asia, and typically it ends up going into China, where the, refined copper is then sold back to the West, or it goes into the Chinese Communist Party's strategic reserves, which they have a lot of. So I think to remove those bottlenecks, the smelting capacity in Arizona, has to be looked at as well. And this is one of the benefits that this project has. The Cactus Mine is ultimately, we'll be producing copper cathode, which is a finished product, LME Grade A copper cathode, which is 99.9% pure, meaning it can be sold directly to US manufacturing and doesn't have to go offshore for further reprocessing and then sold back to the West.
You made a few excellent points there. So the smelting capacity in the US is totally insufficient for what we need. And yeah, there's 2 operating smelters. One is in Arizona. I think there's another one that could come back online with a little refurbishment. But still, that's not enough. For a country this big with as many copper mines and copper projects as we have, we should have more like 6 or 7 smelters, not 2. And that's something that the Trump administration did address in some recent, executive orders. It'll be interesting to see the details and the timeline to actually build new smelters. But at least there's a positive sign that the administration understands the bottleneck, they understand the problem. And that is also an important point you made about how Cactus will actually be able to produce finished copper cathode, which can be sold straight into the manufacturing sector in the US and the end users. So that's very valuable, because you'll get paid more for your copper as opposed to what you'd be paid if you were shipping it to China, right?
Yeah, and we're seeing that at the moment when, Trump administration announced several months ago that they were undertaking a Section 232 review of copper, and potentially there could be tariffs going on copper coming into the country. a lot of traders have been moving physical copper metal out of Asia, out of Europe, and over onto COMEX. And we've actually seen an arbitrage there where there's a higher price being paid for metal on COMEX that's in excess of $1,000 a metric ton, which is very, very unusual. So if tariffs were to come into play, obviously copper, produced within country won't have tariffs applied to it, and therefore it's going to be a more valuable product, and you would expect there'd be a premium on the price to be paid for that. So it's a great situation for Arizona Sonoran and our shareholders when we look forward to putting this mine ultimately into production.
Yeah, so potentially you could receive the premium pricing for your copper because of the location inside Arizona.
Yeah, today, for example, COMEX, I think that the price is around $4.90, and the London Metal Exchange price is sitting around, $4.40. So there's a 50 cents, premium, or almost $1,000 a ton actually being paid for metal on COMEX today.
Got it. And then just one more before we get into Cactus itself. So the Resolution project gets a lot of headlines. It's in the press again this week. Resolution is obviously the biggest and highest grade copper deposit that's sitting dormant, I guess. It's waiting for final permits. But it's owned by Rio Tinto. The two largest mining companies in the world have a JV on it. And it's obviously extraordinary because once it is in production, it will supply a lot of copper, but it's been waiting for permits for 20 years. What's the scoop on Resolution? And if it does finally get permitted and starts to get built, what does that mean for a company like yours?
Well, it's a great question. It has been in permitting for, I believe, in excess of 20 years. The main challenge there is that some of the lands where the mine is located, I think, belong to the tribal lands of one of the Apache, tribes there. And there's been this issue of, whether they could actually do a land swap with the federal government who are offering up federal land. So the Trump administration actually just this week announced 10 projects which they are planning to fast track under a policy or an executive order which they've put in place, and Resolution is one of those. But even if it moves forward, it's still going to have to follow the current regulatory environment. There's still going to have to be a NEPA 404, EIS and all of that. And it can be speeded up, the process for government review. But if the mine moves forward, it's still going to take 10 years to actually realize, any production from that mine, because it's a deep underground mine. And as you alluded to, it is high grade, but it's down about 3,000 vertical feet below surface. So it's going to take many, many years to develop the infrastructure and just put in the development to access that ore body and open it up enough so that it can actually be mined. But it would be extremely positive for the state and for the US if they could, secure those strategic minerals in that copper being produced from Resolution.
All right, so let's move on to Cactus and talk about where the Cactus mine is at currently in the mining life cycle and why this is an important year. I mean, just looking at your deck, there's a slide that has some timeline and some key milestones, and this is a big year. Tell us about that.
Yep. So we're currently undertaking what's known as a pre-feasibility study. We're anticipating that this will come out in the second half of this year. We put out a preliminary economic assessment last year, August of 2024. And using a $3.90 copper price, we realized an NPV8 after tax of $2 billion US, an IRR after tax of 24%. The mine generated over $7 billion US in unlevered free cash flow over a 31-year mine life. And importantly, in the first 20 years of production, we saw average annual production over 100,000 metric tons of copper cathode production. So the PFS is currently about 50% complete. We're seeing very, very good favorable results coming out of the work that we've completed to date. And we believe that when the PFS comes to the public markets in the second half of this year, it'll very much be in line with what we put forward with respect to the PEA, certainly with respect to a 20 plus year production life of mine. Once that is out in the public domain, we would then move into what's known as a bankable feasibility study. That's going to take about 9 to 12 months to complete. That'll then come out in the second half of 2026. And between now and then, myself and my CFO will be working with a project financial advisor that we'll be announcing soon to actually bring in potential project financiers on the project, so that when we announce the BFS in the second half of 2026, we can also announce the project financing is in place. Currently, we're looking at an 18 to 24 month construction and development period. So if we can break ground before the end of 2026, we could realize copper cathode here at some juncture before the end of 2028, which is a relatively short period of time to bring a copper mine into production. And of course, the advantage we have here is it's a brownfield site. There's already an existing open pit there. Mineralization that we've newly discovered in the last 4 years is very close to surface, so it's easy accessible. And we're in a very rich infrastructure area, meaning we have access to roads, power, water, a community on our doorstep, so we don't have to build a camp. So that keeps the timelines and the upfront capital relatively low compared to other copper projects around the world.
Yeah, and I want to thank you for inviting me to site at the end of last year. That was a nice visit, and this is one of those projects. I mean, I don't want to hype you guys up too much. I don't want to have the viewers think that I'm trying to get people to buy the stock or anything, but it's just my honest take after being to site that this is an virtually ideal location to build a copper mine for a number of reasons. Great infrastructure, highway in close proximity. You're within, 5 to 10 miles of a small town in Arizona where there's a pretty good potential labor force. And this is also, it's interesting though, because it's unique. You have a town within 10 miles of the mine site. And some people say, oh, that's too close. No, it's actually not, because when you actually get there and you stand by the pit, there's nothing. You can't even really see the town. It's just wide open, flat country.
We're in an industrial park, so we're away from the city. And then you have to think back to, why is the city there today? The city is there today because of the initial discovery way back in the mid-1960s. And the town was founded really on the basis of the Sacaton Mine when it came into production in the 1970s. Now, the mine did close in 1984, so it's obviously been dormant for some 50 years. But there is a mining heritage and a kind of mining culture still at the core of the city today. So they recognize their roots, or where the city came from. And every time that we've conducted what we call a perception survey over the last 4 years, we've conducted 3 of them. We've always seen the favorable rating for the mine coming back into production actually growing as the mine has got larger and the life of mine has got further pushed out. And indeed, the last perception survey we completed last year in November, which was 3 to 4 months after the PEA had gone out, so that we could disseminate that news into the community and wait for feedback. We actually saw a favorable rating of 87% in favor of seeing the mine come back into production from 500 respondents. So that was extremely pleasing, and that was up from an already high number of 83% in a former perception survey that was conducted a couple of years prior. So we've definitely got a very, very strong social license to see this mine come back into production. And this is the thing in the mining industry, is that, you know, these jobs will be extremely high paying jobs. You know, typically the average salary or wages is about $85,000 a year. And you can have miners that will be earning anywhere from 120,000 upwards to 180,000 dollars, depending on their level of skill and experience. So these are not low paying jobs paying $15 an hour. These are extremely high paying jobs. And that is what will also attract people to see the mine come back into production.
Yeah, I mean, it's a great location for a number of reasons. It pretty much checks every box. The only one would be the question mark is kind of what you just addressed, and that is, well, will the population of this town want to see a copper mine get built or go back into production next door to them? Well, I mean, it already was in the 70s and 80s. And really, you know, it's not, yeah, you can see it on the map, you can see it looks kind of close, but really, like, when you're standing at the mine,
the scale is massive. You don't realize that the open pit is almost a mile across.
Yeah.
In diameter.
So at Cactus, it's called the Cactus Project, but what it is, it's a porphyry cluster. So you've got different porphyry centers sort of in a trend, including to your neighbor, which is the Santa Cruz project. And basically, from my understanding, Cactus East is the porphyry deposit that's closest to surface. And then as you trend to the southwest, Park Salyer, and then over to Santa Cruz, you're getting deeper and deeper and deeper into the earth. So let's just talk a little bit about getting this back up and running again, 2028 or 2029. So where do you start the mining, operations?
Well, the PEA, and we think the PFS will follow this same sort of schedule, but the PEA had mining initially starting at Park Salyer, which is about 2 kilometers to the southwest of the old Sacaton mine that we call Cactus East. The reason why we're looking at that area is we have mineralization that comes within 42 meters of surface, which is relatively close. But the grades over time at Park Salyer are superior by 2 to 3 times what we see at Cactus West or the old Sacaton mine. So the margins that we can make at Park Salyer are significantly higher than just going into the old open pit and doing a layback. So for example, at Sacaton, the grades will be anywhere between sort of 0.3 and 0.4 total percent copper. But eventually at Park Salyer, we see grades that are anywhere between 0.6 and 1% total percent copper. So you get that huge grade bump and therefore much, much better margins at Park Salyer. So the first 10 to 15 years of the mine plan will be very focused in on Park Salyer.
Okay, that's interesting. And I know the answer to this question, but I want you to answer it for the viewers. I notice in your news, you report total copper percentage grade. Most junior mining companies just give a CU number, whatever, 0.5%, 0.55%. What does total copper mean?
Well, within the copper, we've got oxides enriched, and we also have a primary sulfide. And when it comes to a leaching operation, the grades that you want to be looking are total soluble grades, which are always, below total copper grades. So we report both, but ultimately when we go to a heap leach SXEW, our extraction rates will be based against a total soluble copper. Now, total copper, we're looking at that as well, because at some future juncture, we've got the Newton technology, which might be able to extract copper from the primary sulfide, i.e. chalcopyrite. So that gives us access to, additional copper. Or at some future juncture, you might want to consider looking at a flotation mill and producing a copper concentrate. Once all of the oxide leachable copper has been processed, you're then going to have exposed a lot of primary sulfide, and it's what you do with that beyond year sort of 20 in the mine plan. So flotation could then be looked at, which is the process they used back in the 70s and 80s when ASARCO ran this operation. It was a copper concentrator that was actually there.
I see. So it's about the method of, recovery. So right now you're envisioning this as a heap leach copper mining operation, but at some later date, once you get more into the hypogene, into the sulfides, then maybe you're going to build more processing capabilities to float this, the chalcopyrite, as you said.
Yeah, well, we're working with Newton, and we're running phase 2 column tests there on the leaching of the primary sulfide, and those tests are up and running right now down in Bundoora in Australia. They've been up and running for approximately 4 months. So by the end of this year, those columns will be fully have ran out, and we'll know what type of extractions are we getting with Newton on the primary sulfide, and can that be built in on top of our pre-feasibility study that will come out in the second half of this year. And then beyond that, a further contingency that we would have would be to look at just putting in a traditional flotation mill and making a concentrate. And we think within the pre-feasibility study, we're going to capture that. I think it's section 26, which is the opportunity section, to show the market what a flotation mill would look like beyond year 20, when a lot of the material we could be mining is primary sulfide.
Okay, but to be clear, so when this is envisioned to be restarted 2028 or 2029, the first area will be the oxides, or sort of like the supergene layer at Park Salyer?
Correct.
Okay.
That's correct. And then that'll be at Park Salyer. And then once we get in and around year 10, while we're still mining at Park Salyer, we then start doing a pit layback at the Cactus West, because there's oxides and there's supergene material there, which has to be mined. And when you combine those two together, it's going to give us about a 20-year mine life of just oxides and supergene material, which can be leached. Beyond that, we then get into the further opportunity of the primary sulfide.
Got it. Okay. Now I want to dig in a little bit on this royalty transaction that was announced in February. So I was doing some math last night, 10 o'clock at night. I was spending an hour trying to refresh my brain on net smelter returns and how you imply what the valuation of the price. And it's complicated. I don't think there's a magic formula to figure out the numbers. But I want to pick your brain a little bit on this, because this is kind of interesting. It might not be something that many investors really paid attention to, but I invite everybody to read the news release from February 13th that Royal Gold purchased an existing net smelter royalty on the Cactus Project for cash consideration of US $55 million. Now, they didn't pay it to you guys. They paid it to a company called Tembo Capital, who held this royalty from whatever, 5-10 years ago. and they paid 55 million. But within the news release, the Arizona, Sonoran company has the option to buy back 0.5% of this 2.5%. So you're buying back 0.5% of a total 2.5% for $7 million, and you have to do it in the next couple months. So you have a deadline here. So this is going to be very interesting to see what happens.
Yeah,
I know what I think should happen based upon my analysis last night, but I'm interested to hear your thoughts on this transaction and what it means for the value of Cactus.
Yeah, so when we run the royalty in our model using a copper price of $3.90 a pound of copper, to buy back that 0.5% based on the current agreement, it's $7 million to buy it back. And when we run it in the PEA financial and economic model, it shows us that it is accretive to buy the royalty back, the 0.5%, and pay the $7 million, because ultimately that's going to put more value in the shareholders' pocket further down the line when this mine ultimately goes into production. So we're currently in discussions with Royal Gold about the buyback of that royalty. We don't have to buy it back by the 10th of July of this year, but we have to officially notify them that we are buying it back by that juncture in time. And what we're doing is we're working with a model based on the PEA. We're trying to get a little bit more advanced with the pre-feasibility study to actually have a financial and economic model based on that, so we can reassess it to make sure that buying the royalty back is indeed the appropriate step to take based on the latest information we have.
And then you have the option to also buy back a 0.14% royalty that's held by another party for US 1.9 million, or 1.9 million. So if 0.5% is a good deal for 7 million, then 0.14% should be a good deal for 1.9 million, right?
Yeah, exactly. It's exactly the same. We're busy assessing it within the latest draft financial and economic model within the PFS, but we have been in discussions with Elemental Altus about the buyback of the 0.14% NSR.
Okay. And then I was thinking, okay, what's Royal Gold thinking here? And is this a prudent move on their part? Is this a wise investment? And I was running some numbers. Now, obviously, permitting risk is real and operational risk is real, but based upon all the projects I've reviewed over the years, this is pretty low risk in the realm of mining operations. So I think these future cash flows are relatively high. Probably they're not 100%, but maybe they're above 50% for sure.
Yeah.
And this is a copper porphyry deposit that is very large. There's a lot of metal in the ground, so a lot of future revenue streams. Seems like they got a good deal. I mean, I was just using some ballpark math, and I came up with over 100 million is what I think this royalty is worth.
Yeah, well, look, the way Royal Gold would value the royalty is they would assume that we're actually buying back the 0.5% for 7 million. So in effect, they paid $48 million for a 2% NSR. And when we run it in our model, we came to the same conclusion that we think they got a good deal, even at a $3.90 copper price. Based on the conversation we had before about supply and demand fundamentals for copper, I think everybody you ask about where's the copper price going to go in the next several decades, I think everybody would tell you it's going a lot higher than $3.90 a pound of copper. So, I think at the end of the day, Royal Gold will be rewarded ultimately for their investment when this goes into production. And the other thing is, with this deposit is it's not just copper at the moment. Obviously, with a heap leach, we can only recover the copper. But if ever again we looked at flotation in this system, there's a little bit of gold, there's some silver, and there's actually molybdenum. And it would be quite easy to put a moly circuit in the mill and recover some molybdenum, which obviously is another critical mineral metal for the world and for the US.
Absolutely. So it's not just copper. There's a few other, metals that you'll be extracting as well. So let's talk a little bit about permitting, because I mean, it seems to me like the project, the ore bodies check a lot of boxes. The location checks a lot of boxes. The share structure, the shareholders of the company, which we haven't even talked about, well, that checks a lot of boxes. We could talk about the Hudbay investment too next. But permitting. So this was a former operating mine. So what does that mean for what you have to do to permit this?
Well, the mine went through all of the permitting way back in the 1960s and early 70s when it first came into production. So it's already gone through significant permitting. Because the land that we have, the 5,800 acres, is also all on private land, there's no federal nexus here. So we only have to get the permits amended, and to get those amendments, we work with the state regulators and the local municipality. So today the mine is fully permitted for an old PEA that was part of our qualifying document for the IPO in 2021. At that time, it was only an 18-year mine life and 28,000 tons of copper cathode production a year. But if we wanted to build the mine tomorrow on that plan, we are fully permitted. Now, since then, over the last 3.5 years, as the resource has grown and the plans have evolved, we've gone and sought amended permits. So we've now got an amended aquifer protection permit, and we've also got an amended industrial air permit. And the way it works in Arizona is with no federal nexus, once you make an application for a permit amendment and the application is administratively accepted, it starts a clock ticking, and within 6 months, the regulator must give you a response to your permit. And the longest that we've had to wait for any amended permit today has been 5 months for that amended aquifer protection permit. And when we got the industrial air permit amendment last November, that was a 4-month exercise from when it was administratively accepted until the physical permit was received in our office. So with the PFS coming out in the second half of this year, we intend to make the application for the final amended permits that the mine will actually be built on. And assuming that those applications go in before the end of this calendar year on the back of the PFS, we would expect in the first quarter of next year, they would be administratively accepted. And then if we take that forward and extrapolate out 6 months, by the third quarter of 2026, you are going to be in possession of all your final permits to actually build the mine. And that's at a point in time when the bankable feasibility study is becoming due. And that's at a point in time when we would be announcing project financing is in place. So it puts us in a great position to make a final investment decision before the end of 2026 and start breaking ground on the construction and development before the end of that calendar year.
So bankable feasibility study in, let's say, mid-2026. You'll also have full visibility to all the permits that you need in 2026.
And project then financing.
Project financing. Okay, so that's the next thing, project financing. So I believe this is another question mark for investors, and it's always an important thing that one must consider when investing in a mining company, because the mine could get built, the mine could be great, but shareholders might lose because of dilution or bad financing terms. So how does a 225 million market cap company pay for a $700 million capex build?
Yeah. Well, look, we're $225 million today, but we've got to look ahead, to where we're going to be in 12 to 18 months' time. So first of all, when you look at the value of the company, on a $2 billion NPV for the PEA, we're trading at around 0.1 times price to NAV. When you look at the consensus that the 8 analysts who cover the company have us trading at, we're trading at 0.2 times price to NAV. When you look at our peers, they're trading between 0.3 and 0.6 times price to NAV. So we believe when the pre-feasibility study comes to the market in the next 3 to 4 months, and the market is able to digest that, there's going to be a re-rate on this company, and we could quite easily see the share price increase by 50 to 100% from its current level around $2 Canadian share price. So that's going to increase the market cap of the company. Then on the PEA, we brought in a commercial bank and we brought in a secondary tier lender under an NDA to conduct project financing on the financial and economic model that came out of the PEA. The commercial bank ran the model at a stress test level of $3.50, and the secondary tier lender stress tested the model at $3.75 a pound of copper. And in both instances, they concluded that the project would be project financeable if we could repeat that for the PFS and then later the bankable feasibility study. And that was looking at a 60 to 40% split of debt to equity. So we'll be conducting that same exercise once we've got a financial and economic model on the PFS. This is why we'll be bringing in a project financial advisor so they can look at the model through the eyes of a project lender and tell us ultimately how much leverage or how much debt can the company take on to finance this project, while at the same time minimizing, the issuance of equity and potential dilution to the shareholders of the company. There's another advantage that the company, I think, has, and this will be part of project financing, but it comes back to the point we were saying earlier about copper cathode and how valuable that is going to be within the United States of America. We have not gone out and looked at, awarding any offtake agreements where any trading groups can get access to our physical metal. But that is going to be a huge part, I believe, of our project financing, because that copper cathode is going to be very, very valuable, not just today, but in the next 3 to 4 years when this mine comes back into production.
Yeah, so that's like a potential stream that you could sell, or just an offtake agreement where you give 1 or 2 parties, exclusive rights to your copper cathode.
Correct, and for that you get a prepayment, so to speak, which allows you to, spend that on upfront capital and put the mine into production.
Okay. January 31st, you announced closing of financing with Hudbay. Now, Hudbay is a mid-tier copper miner, also zinc, a few other base metals, and they actually have some projects in Arizona. So they're not new to the state of Arizona, although it's a Canadian company. How did the Hudbay investment come together, and what sort of feedback have you received from them?
Well, how it came together was we put out our PEA last August. We were approached by quite a few corporate development teams from various, mining companies. We ultimately decided to let Hudbay into our data room in late August, early September of last year under an NDA. They conducted 4 months of virtual data room due diligence. They also came to the site for a physical visit. And usually every 2 weeks after they'd been in the data room and they had further questions, they would jump on a call with the project management team, and we'd have a sort of 2-hour session going through Q&A and answering all their questions. After conducting that due diligence, I was contacted by their CEO, Peter Kulkowski, in December of last year, and asked to come downtown to Toronto to meet with them at their head office, where Peter proposed actually putting a strategic investment into the company. When we discussed it internally, we felt that this would be a great result for the shareholders of the company. First of all, they were willing to put the investment in at a then 15% premium to the 5-day VWAP price. So the price at the time was $1.45. The offer price was done at $1.68 Canadian. And of course, since the announcement of that deal just several weeks ago, we saw the share price move up to $2.52, which was an all-time high. Although on the back of the Trump tariffs, it's now fallen to, I think today we're trading around $2.17. So the market has reacted extremely well to the investment by Hudbay, where they have taken a 9.9% position. There's no board seat. They do have an observer on our technical committee, and they have the right to follow, their future investment through preemptive rights, piggyback rights. If and when we do further financings, they can participate to maintain their 9.9% position. So this is a huge check mark of validation and credibility for the project and the management team, having Hudbay put in 20 million Canadian dollars at that time to the company to take this strategic stake.
All right, and then a couple more questions, and then I'll let you go, George. Your neighbor is Ivanhoe Electric, and this is a very interesting topic for me to think about, because obviously they're a larger market cap company. They have a lot of visibility due to their chairman, Robert Friedland. And the Santa Cruz project is, well, it's pretty high grade, right? It's above 1% average copper grade. You don't get many big deposits with those kinds of grades. And I think maybe it's not as well understood that, well, at Park Salyer, for example, you have high grades too in the oxides and the supergene. You have a lot of grades above 1%. But they get a premium valuation likely due to Robert Friedland. And also they just announced that they got a letter of intent from the Import-Export Bank, the U.S., $825 million. So just interested, what is your conversation, or do you have conversations with Ivanhoe Electric, and what kind of feedback do you get from maybe companies like Hudbay or maybe some other larger mining companies about how they view this district? Because obviously it's the same ore body, it's just separated. Yeah.
Well, first of all, it is the same mineralized system. As you stated earlier, in the northeast, the mineralization is relatively close to surface. And then as you trend to the southwest, the mineralization gradually gets deeper. So their deposit has higher grades than ours, but it'll be an underground sub-level cave or open stope mining. So the mining costs will certainly be higher there. But of course, it's got higher grades to offset that. They have a reported 10 billion pounds of copper in the ground based on their current 43-101 resource. We're sitting at 11 billion pounds. So if you put the two projects together from a resource perspective, you'd be sitting at over 20 billion pounds of contained copper in the ground, both on private land with access to water, significantly permitted, and all of this very rich infrastructure. That is definitely a size of deposit that would interest the biggest players in the mining space, particularly in the copper space. So the likes of a Rio, a BHP, a Freeport McMoran, I think would be interested given that size. So there's definitely opportunity there down the line, in my opinion, for some sort of regional consolidation. But it's got to be the right time for both respective companies. And, Ivanhoe Electric, for some of the reasons you stated, gets a very, high premium on a price to NAV basis. Whereas at the moment, as I described earlier, we just feel as if we're very undervalued, and we really need to see a re-rate of Arizona's Sonoran so that our own shareholders can get, true value. At the project level, the teams are talking on a regular basis, given we're both right in Casa Grande. We use the same suppliers, the same vendors. So there is constant, communication there. At the executive level, when myself and Taylor Melvin are attending, similar conferences, we will try and meet up and have a conversation with one another and just sort of catch up on how our respective projects are advancing. And of course, they have a pre-feasibility study coming out sometime before the end of the second quarter. And then we'll be following that up sometime probably before the end of the third quarter with a PFS, and we'll see how the projects match up with pre-feasibility studies on the table.
Do you want to build this mine, George? Are you the guy that's going to be here at the helm in 2029? Are you going to see this all the way through the build?
Yeah, well, it's a great question. And look, myself and my project team are all people with experience of running, operating mines, putting brownfield mines into production, turning around broken stories and getting them fixed up and creating shareholder value. So we absolutely have the skill set and the capability of de-risking this mine, moving it forward through the technical reports, project financing, construction and development, putting it into production, and actually running it. Now, I think at some juncture over the next couple of years, somebody is likely going to approach us and inquire as to whether there could be an M&A or an acquisition opportunity. And when it comes to negotiations, if the management of the mine understands and believes that they're ultimately going to be held accountable for the delivery of those technical reports and actually delivering on those when the mine is in production, you always end up with a superior technical report, a superior product. And anybody conducting due diligence on the company is going to quickly realize that these are real productivity numbers, these are real operating costs, these are real capital numbers, these are real sustaining capital numbers. And therefore, if you're negotiating on the sale of the company, you're doing it from a position of strength, knowing that the data, the information is credible. And if you don't get the type of premium that you absolutely believe you deserve, then you can walk away from the table and you can build the mine and put it into production yourself. And ultimately, I think that's how this thing's going to play, is as we continue to de-risk this and the market realizes that this is a quality asset that can be brought into production for relatively small sums of money and low capital intensity in a short period of time, somebody's going to come and approach us in the next couple of years. And I got to make sure that between now and then, we get maximum value for our shareholders.
By the way, your share price is back in an uptrend. I mean, obviously, we had that market upset in early April, but back to 222 a share and moving up. And Freeport is up to 37, and some other copper mining stocks are also carving out uptrends. So maybe the worst is behind us, knock on wood. We've talked about a lot of the positives of Cactus. We've talked a lot about your background and your strategy to advance this project forward. What keeps you up at night? Like, what worries you? What are the challenges that you face?
Well, this one's relatively straightforward compared to the challenges that I've faced in my career at other operations, whether it be Rubicon or Kirkland Lake Gold, getting that one turned around. So I'm not particularly worried about this one and putting it into production and ultimately building a solid mid-tier copper company in the heart of the Arizona copper belt. The key thing I think is going to be is the project financing and ensuring that we start that exercise early enough to give ourselves enough runway to look at all the options and ensure that when we put that project financing in place, we've got the best structure possible to minimize dilution for the shareholders of the company and, maximize our NAV per share, which is ultimately, what we want to achieve.
George Ogilvie, thank you so much for your time today. This was a great conversation.
Hey, thank you, Robert. Appreciate the opportunity.